questions about a rising dollar. How can this happen? Is it just Deutsche Bank? And what happens next? Good afternoon. I'm Tom Luongo. It's Friday, October 14th, 2016. So this week we had a real major move in the US dollar. And I'm going to show you some charts in a couple of minutes to bear this out as to why that move happened and what I think is going on. As we all well know, if you're following this at all, you know that the Deutsche Bank is in serious trouble financially, and despite protestations to the opposite and everything else, when you know a bank is in serious trouble when the CEO comes out and says, "No, really, we're adequately capitalized." And Dick Folt said that about Lehman Brothers, and Bear Stearns imploded so quickly that no one even had a chance to issue a statement about that. But the situation with Deutsche Bank is really it's systemically important, and I think we're pretty much all well aware of that. But I think it's bigger than Deutsche Bank, and with the Fed having been talking down the dollar now for 6 months and refusing to raise interest rates, it's funny that a rising dollar is kind of counterintuitive, right? Well, no, not if dollar liquidity is really tight. And if you like me follow the Fed's balance sheet every week, you'll note that liquidity in the banking system has been incredibly tight for 4 weeks now. And sometimes that happens towards the end of a quarter, like we had a couple of weeks ago at the end of September, when the banks will go to the Fed discount window or to the reverse repo window and use that to go grab a bunch of assets from the Fed in order to shore up their balance sheets so that they can make everything look good for the end of the quarter report. And then after the quarter ends, they sell all the assets back to unwind all the trades, and everything relaxes back, and then they can pretty much report whatever they want in their earnings report. And my subscribers over at Resolute Wealth know this shuck and jive really well because I talk about it regularly. But that's not what's going on right now. What's going on right now is that we normally don't see this kind of behavior, this kind of excessive tightness in the banking system go past the end of the quarter. And now we're 2 weeks into October and we still have it. So maybe it is just Deutsche Bank, or maybe it's something systemically bigger than that, or maybe the troubles that Deutsche Bank is having are now finally making it clear to everybody that there are bigger problems than just that. I noted this morning or yesterday that Singaporean GDP for Q3 was awful. When you start seeing really ugly stuff coming out of major emerging markets like Singapore and Taiwan and Korea and others, that's usually a sign of massive currency stress. And ultimately, I think the Singapore dollar is up to $1.37, which is crazy. But it just means that at the end of the day, there's a tremendous demand for dollars out there. And Martin Armstrong talks about this stuff all the time, and he's absolutely right. I did the math, I think, last year from the Fed's own data that since we went to zero-bound interest rates, non-bank foreign corporate debt has risen by more than $4 trillion. And so, if global trade is slowing down, we're on the verge of a global recession, where are these companies going to get the dollars they need to service that debt? And like I said, my subscribers over at Resolute Wealth understand this, and I've been making this point to them for a long time. But for other people, they don't necessarily know this stuff. And so when you see a massive stability campaign like we've seen post-Brexit since July, and this is a chart of the weekly chart of the euro. This is what I'm talking about here. When we see this kind of inability for a major market to move very much, it's usually a sign that there's coordination between the central banks. We've certainly had that all summer long, with the Fed refusing to raise interest rates, with the Bank of Japan continually disappointing the market with more QE to trash the yen. The yen has strengthened all year by 15%. So there's a lot of stuff. There's a lot of this coordination going on in order to keep the euro from breaking down. And today, and yesterday and today, and with the weekly close that we have, literally, we're gonna have in about 15 minutes. I'm recording this right before the NYMEX closes. That we've got a major breakdown of this range here on the part of the euro, and any move, we're less than 50 pips away from, or we're less than 20 pips away from a major breakdown on the monthly chart, and then we're looking at $1.05. And if we're looking at $1.05, I can tell you that with the ECB having moved so much European debt into negative territory, we have a sincere problem, because the minute the euro starts to break down, the reason why the euro needs to stay within a very tight band is because, one, we've had a massive move in the pound post-Brexit, so we kind of have to hold the euro tight, hold gold tight, and I'll show you the chart of gold in just a minute, in order to be able, for the ECB to be able to drive interest rates on European debt lower, right? But once the currency breaks down, then all of those massively overvalued or ludicrously valued bonds, those carry trades have to be unwound. They're no longer profitable. And so that's why we're seeing continued upward pressure on German bunds. And you use German bunds as a proxy for this, because obviously the German bund is the European equivalent for like U.S. treasuries. They're the most stable. They're the most well regarded in the investor class of all the sovereign debt in Europe. So if German bunds are under pressure, what does the rest of Europe look like? Which is why the ECB is buying all that debt, the Portuguese debt, Spanish debt, Italian debt, and whatnot. So is it all Deutsche Bank? No, I think some of it's Brexit. I think some of it is emerging markets. I think some of it is the global slowdown. And, in a sense, Deutsche Bank is the thin end of the wedge. It's the tip of the spear. It's the straw that breaks the camel's back. So, given an idea here, we've got a situation with gold. Now, look, this was last week in gold when it broke down, right? And it was trying to break down into the end of the quarter. And gold is a classic. When gold acts like this, it's usually a classic sign of dollar liquidity stress, because gold is the easiest thing to sell. I mean, look, I know that they're out there, mucking with the markets, and I know that they manipulate everything that they can. But at the end of the day, gold is the most liquid anti-dollar out there. It's the easiest trade to make. And when a guy is long gold and he needs to raise dollars, he's going to sell his gold first before he sells his other tier 1 capital. It's just what he's going to do. And that's the way it is. And so what we've got now, and this is what happened with Brexit. And if you really look at, look at how tightly gold traded between, between Brexit here and, between Brexit and 2 weeks ago, it's pretty impressive actually how tight gold traded. But it was trading with a bearish tint. And then eventually, once we started getting into real serious liquidity issues, gold got whacked. And it's right now trying to hold this low, this post-Brexit or pre-Brexit low of 1253.70, 1254, depending on your source, right? And the real, if this breaks down, then we're looking at 1200 in the short term. So I just wanted to bring all these things up to you. If you're wondering why, with all this QE and all this money printing and everything else, why the dollar is strengthening, this is what's going on. It's about the demand for dollars and the marginal demand for dollars in an acute short-term scenario. The same way we saw it during Lehman Brothers when gold got whacked the weekend that Osama bin Laden was captured. Silver peaked at $50 an ounce and then crashed, and then gold rolled over right after that at 1033, and then it bounced around, and eventually it crashed to a low of around $680 during the financial crisis in 2008. And everybody's like, the world's... No, that's exactly when you buy gold, because that's the moment when policy has to change in order to deal with it. So what I think is going to happen in the future is that we're going to get a move to stabilize Deutsche Bank at some point, but it's going to have to get a lot worse before it gets better, because there's no political will for it to happen in Europe right now. The Germans are dead set against bailing out Deutsche Bank, but they won't be when it gets acute, or they won't be able to sell it to the public until it gets really acute. And in my mind, that's somewhere about $4 to $5 a share. So, take that information for what it's worth. But in order for something like that to happen, it's going to have to be when it gets really acute, and it may have to also mark the end of Angela Merkel's career as Chancellor of Germany. And again, that gets into other geopolitical issues as well. So, she's the Americans' pet, European leader. She does everything we ask her to do, and that's not a tenable situation either. So at the end of the day, the Fed is paralyzed, the banking class is paralyzed, the quote unquote the powers that be are paralyzed, caught between a rock and a hard place. as we approach the election. And I think that the euro breaking down this week is a harbinger that we may have some real rocky times ahead of us between now and election day. And I think that we're not done yet. If you've thought this is crazy to this point, I don't think we've even gotten started yet. I think the next 3 weeks are going to be a hot time in the old town tonight. So that's all I've got. You guys have a great weekend, and keep your stick on the ice.